This video is for education only and isn't financial, legal, or tax advice. Trading involves risk and past results don't guarantee future performance.
We've got less than 3 months left in this year, and most of you guys watching this are nowhere near reaching your goals. I know plenty of you guys start every single new year creating goals, saying that you're gonna start new things, make more income, have more freedom, but you guys just keep doing the same things. You guys don't make any change and you aren't disciplined. The people who win in Q4. They don't wait until January to reset. In this video, I'm gonna walk you through the smartest path to scale to $10,000 per month using options trading. And truthfully, if you start now, you'll be miles ahead of everyone else who's waiting until January to reset and reach their goals. Before you ever place a trade, you need to get set up correctly. That means starting off with opening a brokerage account. Here in the United States, you have plenty of options. The broker that I use is Thinkorswim by Charles Schwab. You could also look into Fidelity, Webull, or Robinhood. All of these brokerages allow you to trade options, but they're not all built the same. If you're brand new to trading, you don't need the fanciest platform in the world, but what matters most is that you know how to actually navigate it. You should be able to open a chart, open up the options chain, know how to enter a trade, and most importantly, know how to exit that trade fast and be able to place a stop loss. Because trust me, the last thing that you would want is to be stuck in a losing trade because you don't know which button to hit. Now here's something most beginners don't find out until it's too late. The PDT rule. So there's certain restrictions on margin accounts that doesn't allow you to be a pattern day trader. If you have a margin account, you have restrictions for day trading.
Cash accounts aren't subject to the PDT rule, but trading is limited by settled cash on cash accounts.
Most people think that they're not allowed to day trade options unless they have $25,000, but that's further from the truth. The pattern day trading rule is a restriction on margin accounts under $25,000, where it only allows you to take 3 day trades in a rolling 5-day period. That is an SEC rule. It applies across the board, and that's where most beginners get stuck. So if you're starting with a smaller account under $25,000, I recommend to open your account on Charles Schwab, Thinkorswim, and open a cash account with margin turned off. And you'll be able to take a day trade every single day if you want to. Then there's taxes.
Talk to a qualified tax professional. Tax varies.
Options profits aren't taxed like long-term investments. Options trading profits is considered short-term capital gains, which just means every dollar you make gets added to your regular income from the year. If you're in the 22% tax bracket, your short-term capital gains get taxed at 22%. If you're in the 35% bracket, it's 35%. So don't worry, it's not complicated. Your options trading profits will simply be taxed just like regular income. However, your brokerage will not withhold any income tax profits. Most new traders forget about this, but the IRS doesn't. It's not too complicated to keep track of your income from options trading. Charles Schwab will send you a 1099 at the end of the year. You just need to make sure you save some of your profits to pay your taxes. And like I mentioned, since you'll be trading with a cash account, not with margin, you won't be borrowing any money to trade. So my trading strategy is all about being smart with your risk management and also making sure we're only trading with the cash that we have and the cash that we can afford to trade with. And we're only risking what we can afford to lose. Setting up correctly is all about building the right foundation, making sure you have the right broker, making sure you understand the rules and regulations, how taxes work, and how much capital you should start out with. One of the biggest mistakes new traders make is trying to trade everything. They see earnings news one morning, so they just jump in. And then the next day is some small cap stock they heard about on Reddit. And by the end of the week, they spread themselves across 5 different tickers, all in different sectors, unrelated, with no real understanding of any of them. At that point, you're not actually trading how a trader does. You need to have similar setups. so you could test your strategy. The smarter way and the way to actually build consistency, especially as a beginner, is to pick your lane. In options trading, I don't focus on IPO companies or earning releases as much. The best lane to stay in is usually sticking with highly liquid companies. These are large cap or mega cap companies that move cleanly with lots of volume. Think about tickers like SPY, which tracks the S&P 500, or QQQ, which follows the NASDAQ, or single names like Apple, Microsoft, Meta, Netflix. These are highly liquid, which means that there are always buyers and sellers, which is very important because if you want to buy to enter your trade, there has to be someone on the other side to sell it to you. And if you wanted to sell to exit your trade, there has to be someone on the other side to buy it. So your stock tickers must be highly liquid, especially if you're day trading. The last thing you want is to be stuck in an option that you can't actually get out of, even if you place the order. By focusing on just one or two tickers, you intimately learn the behavior of that stock. You learn the exact patterns that form when it reacts to your levels. You start to recognize different volume patterns, and you could track that specific stock's price action behavior. Every ticker has its own unique rhythm, but you could only hear that rhythm clearly if you stop trying to trade 10 tickers at once and you start focusing on the one. Clearing the field also makes your decision making cleaner and easier. Instead of scanning hundreds of stocks each morning, you wake up, you know exactly what you're watching, and you put all your focus there. That's how the pros do it. They master a specific strategy or setup on a small handful of tickers, and that's how they build repeatable and consistent trading profits. Think of it like sports. A football player isn't also training like a cheerleader or a swimmer or a boxer all at the same time. They specialize, and because of that, they become world class in their lane. Trading is no different. So pick your lane, clear the noise, and commit to mastering a specific setup on just a couple of names. That alone will separate you from 90% of beginners who are all trying to do Forex, options, futures, crypto all at once, and it just makes no sense. Once you've picked your lane, the next step is learning how to actually read what's happening on the chart. And here's where most beginners overcomplicate things. They'll go to YouTube, learn trading strategies, find 10 different indicators, add them all to their chart, a rainbow of moving averages, RSI and MACD, and adding Fibonacci levels. And all of that BS. And by the end of the day, and when they added all these things to their chart, they're more confused than where they started. And the truth is, price is the best indicator you'll ever have. When you read price, you'll open up a candlestick chart and you'll begin to analyze how the candlesticks move and react at certain key levels paired with volume. Reading price just means analyzing how the candlesticks move, how volume shows up, and how the market reacts to key levels. For example, when you open up a stock chart, pay attention to how price reacts at certain levels. If it is a key level of resistance, you'll notice that every single time price tries and attempts to go higher, it'll meet that level and sellers will step in and then price will go down. That's a resistance level. If you notice in the past that price held below that specific key level that acted as resistance, then in the future when price retests it, you're looking for price to go down and reject it again. But remember, price doesn't just reject levels, it also breaks out sometimes. So if price came up to your resistance level and you noticed there wasn't any strong reversal patterns forming or there was weak selling volume, and if price came up to your resistance level with strong buying volume, that's information. Price could come up to a resistance level, and if you don't see any reversal candlestick pattern and volume is very high, buyers could potentially absorb the passive sellers that were left at the resistance level and push price higher. On the flip side, if you're watching a stock chart and you notice every single price comes down to the low price, it finds support, buyers step in and price bounces, that's your support level. That's your demand zone. These type of levels, support and resistance, are a foundation in trading. You don't need 10 indicators telling you what's happening. Your chart is already showing you. If you're willing to slow down and pay attention, you will spot the signs. And when it comes to options, reading price cleanly is even more important because options move faster with more leverage. If you're buying calls and betting that price is gonna go up at a previous level of resistance, you're setting yourself up for failure. And if price is at support and you're betting puts that price is gonna go down, you're fighting against the flow. But when you align your trades with the clean levels on the chart, suddenly your risk makes sense and your probability of success goes way up. So remember, be smart. Don't make the same mistakes that typical retail traders make. You wanna buy calls near support and you wanna buy puts near resistance. Instead of asking yourself, what do you think that the stock will do? That's the wrong question. You're trying to predict what will happen next. Instead, just simply shift to, what is this chart showing me right now? That shift alone is what turns trading into guessing into a skill. When you're starting out, the truth is your main job isn't to double your account or make a living right away. Your main job is survival. You need to stay in the game long enough to actually learn how to trade. This means you can't go in swinging for home runs. You have to start risking small while you're working on building your skill. In the United States, most beginners open their first brokerage account with something like $1,000 or maybe $5,000 if they've saved up. And the temptation is always the same. You'll log into your account, you'll see a great opportunity, and in the back of your head, you might think, if I just bet big on this one, I could flip my account fast. But that's how accounts get wiped out. It's not because your strategy is bad, and it's not because you can't learn how to trade, but because of one simple mistake: bad position sizing. So let's make this concrete. So if you take one trade that costs $200 and your account size is $2,000, make sure you set a smart stop loss. If you don't set a stop loss, you could be risking around 10% of your account, which is too high. If you set a smart stop loss on that trade, so for example, you enter at 200 and you put a 20% stop loss, in that one trade, you'll only risk $40. Now, this is when the risk management makes sense because your account size is $2,000, but you could risk $40 on one single direction. That's only 2% of your account. An example of over leveraging on a $2,000 account is entering a trade that costs you $1,000, because if you put a 20% stop loss, you'd be risking $200 per trade, and that is 10% of your account at risk. So if you over leverage with too large of a position size, you could wipe out your account in just 3 or 4 bad trades, and you're already staring at half of your account gone. And trust me, that ends up doing way more damage to your psychology than just your account balance. So you want to think in terms of risking like 1 to 2% of your account per trade. On a $2,000 account, that means $20 to $40 of risk per trade. And you might even be thinking, what's the point? I can't get to $10,000 a month only risking $20 per trade. That's true, but here's the thing. At the start, you're not exactly just trading for income. Most importantly, you are trading for information, for experience, and for data that tells you objectively what's working versus what's not working. And the only way to get that information without blowing yourself up is by starting small. Essentially, in your first months of trading, you want to build your skill and prove to yourself that you are capable of being consistently profitable and growing a small account too large. And you don't want to be the type of trader who flips your account fast and then loses it all even faster. So that's why I focus on starting small, building consistency and discipline so I could prove to myself I could remain consistent, so that when I do grow my account, I consistently keep growing it. Think of it like tuition. In the United States, college students pay tens of thousands of dollars a year to sit in a class classroom, take notes, and learn something useful. The difference is that in trading, you could actually control how much your tuition costs to learn the same lesson. If you keep your risk small, you could afford to learn so many lessons while you build your skill. If you go too big, too fast, you'll pay all of your tuition up front and then you won't have anything left to keep learning. And the faster you embrace that mindset, you could stop worrying about getting rich tomorrow and building consistency and discipline so you could actually see repeatable profits. Because once you could prove to yourself that if you're profitable just risking $20 or $40 per trade by the end of a whole month or quarter, if you did that with discipline, then scaling up just becomes math and you could keep following the same process. And what's very important is you should not have anything on your chart if you don't understand what it is, what it means, and how you're going to actually use it. So if you have 15 different indicators on your chart and trend lines drawn in every single way, and you have 20 support and resistance lines, but you don't actually enter trades on those levels because you don't know what to look for, that's not trading. And that's just confusion. What actually works is the opposite. Simplicity. Whenever you have anything on your chart, you need to know how to practically use it. And the best traders I know use checklists for this exact purpose. A defined checklist can keep you from second guessing yourself in the heat of the moment and start paying attention to the most important clues on your chart. Your checklist doesn't need to be fancy. And in fact, it really shouldn't be. 3 to 5 points is enough. For example, here's what a basic options trading checklist might look like. First, is there a key level of interest nearby current price? Second, is the overall market trending clearly and in which direction? Are they cleanly moving up, down, or sideways? Third, is this a setup I recognize? Not something random you saw in Discord. Something that aligns with your strategy. Something that you've journaled before. 4, is there volume? Options need liquidity. From there, if you decide to get your entry, you should also predefine where your stop loss is and making sure it fits into only risking around 2% of your account. That's it. It does not need to be complicated. The point of the checklist isn't to predict the future. It's to protect you against yourself and make sure you follow your rules. It forces you to slow down, check your reasoning, and only take trades that actually meet your criteria. An example on how you would use that checklist is if you marked up the S&P 500 and you found a support level and price is in an uptrend and price tested your support level with strong volume. That is a check, 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 check on your checklist. Here's the beauty of it. Once you've traded long enough, your checklist evolves with you because the point of the checklist is to ensure that you follow your rules. So whenever you have a trading rule, make sure that you add a check to your box so whenever you enter a trade, you could ensure that you're actually following your rules. So maybe you'll add some things to your checklist or you'll remove some things from your checklist depending on how your strategy evolves over time, but you'll never get rid of the checklist. Think about it. Having a checklist makes sure that you could repeat the same setup every time. And if you could be consistent in the type of trades you take, you could build consistency in your profitability too. If there's one habit that I've noticed between consistently unprofitable traders and traders who actually make measurable progress, it's journaling. Here's what I mean by journaling. I don't mean writing essays about how you felt. I mean tracking the key details of your trade in a way you could look back on and analyze later. For example, you want an online spreadsheet or a trading journal platform where you will track this data. The ticker, the contract you bought, including the strike price and the expiration date, your entry time, your entry quantity, your exit times, the strategy you followed, the type of level that you entered at, the reasons why you decided to enter that trade? Was it based on emotions? Was it based on technical analysis? What specifically made you pull the trigger on that trade? What's the context surrounding the trade? You could even include your original plan. How much were you originally risking and aiming for? And then how much you actually lost or win. Then how much you actually lost or won. And lastly, a screenshot of your chart. Once you get in the routine, it actually doesn't take more than a few minutes to fill this out. Once you have all your trades journaled, once a week you could sit down and look back at the trades you've previously taken. Don't just look at the dollar amounts. Look at the patterns. Do you notice that you win more often in the first 2 hours of the market versus the trades you take after noon? That's a clue. Do you notice that you do well when you trade breakouts with high volume, but you perform poor when price is consolidating and you're just forcing trades? That's another clue. Do you see that most of your losses are bigger than your wins because you let your losses run too long and not actually follow your original plan? That's not a strategy problem. That's a discipline problem that you could fix. Once you do this long enough, your journal becomes your edge and your trading playbook. Because when most traders don't bother and they keep guessing and they keep losing, you would have hard data on what works for you. Every platform gives you access to your order history, so you don't need any fancy tools to start. Excel or Google Sheets is enough. The most important thing is consistency. Track your trades, review them, and learn from them so you could refine your strategy. A common mistake I see is beginners trying to scale trading way too quickly. They'll take 2 green trades on Monday and Tuesday and they'll automatically think, okay, I'm ready to double my size. But scaling isn't about feeling confident after a good week. It's about having enough data to back up that decision. No matter your account size when you start, it could be $2,000, it could be $5,000 or $10,000. You cannot size up just because you had a good week. So if you have a $2,000 account size and you're currently working with risking $20 to $40 per trade and aiming for $60 to $100 of profit, and let's say you did hit a couple good trades in a row, growing your $2,000 account to $2,500, can't suddenly jump up to risking $200 per trade just because you had a good week. That's how small accounts disappear, and that's the trap most beginners get stuck in because they get greedy. The right way to scale is to wait until you've built your track record. You want to take 50 to 100 trades in a row where your winners are consistently larger than your losses. And if that's paired with a good win rate, you would have been profitable in those past 100 trades. If your journal data shows you have a good risk-reward ratio and a good win rate, that journal data is your permission slip to increase your size. And when you do scale, it's small steps, not leaps. So if you've just been trading 1 contract on SPY, the next step is 2 contracts, not 5, not 10. Start with those small trades and grow your account so you could let your account and your mindset grow to adjust to the bigger risk you'll take. The goal is to start small, build your skill, and actually become profitable first, and make enough profits that those profits act as a cushion so that you could size up without having to risk a larger percent of your account size, where that percent risk of your account size remains steady at 1 or 2 or 3%. Because the reality is, a $50 loss on 1 contract could quickly turn into a $250 loss on 5 contracts, or a $500 loss on 10 contracts. And if you're not ready for that, it could really mess with your discipline. That's why it's smart to focus on highly liquid stocks that traders naturally gravitate towards, like Apple, Amazon, and Tesla. These names have tight spreads, plenty of volume, and make it easier to scale without added risk of illiquid contracts. Scaling the right way isn't about making money faster. It's about making sure you're still here in the game a year from now. The stock market opens at 9:30 a.m. Eastern Standard Time. The traders who last build a routine around the market. If you're rolling out of bed at 9:25 5 a.m. and taking trades half awake, you're setting yourself up to make mistakes. Your daily market routine does not have to be complicated. Your routine could mean waking up 1 hour before the market open so you have time to do your market analysis, check your watch list, and create a written plan. Let's say you're analyzing Tesla, Walmart, and Microsoft. Write down the levels that you're interested in, the direction you're leaning, and exactly what would make you pass on the trade. Accountability is the second half of the equation. Trading alone makes it easy to break your own rules because no one's watching you. That's why most successful traders keep some form of accountability, whether it's journaling your trades daily, reviewing them weekly, or being a part of a community that holds you accountable and honest. When you know you'll have to explain yourself and your trades to someone else, like why you jumped into that trade without a setup or without confirmation, you would think twice before doing it and even ask yourself, why did I enter this trade? Now, the market is open 5 days a week, 252 trading days per year. You don't need to catch every move. What you need is a repeatable process that you could follow consistently. So build that daily routine. Create a structure for how you start your mornings, how you prepare for trading, how you review and hold yourself accountable to sticking with it. Some names barely move, some have no volume, and some option contract premiums are too expensive for your account size. That's why most traders stick with companies that are both liquid and familiar. Think Apple, Amazon, Netflix, Microsoft, Meta, etc. These are companies everyone knows, but more importantly, their options are highly liquid, so you won't be losing any money from wide bid and ask spreads. The second piece is timing. Just because you're a day trader does not mean you have to be glued to the screen from 9:30 a.m. to 4 p.m. when the market closes. The cleanest moves often happen in the first 90 minutes of market open, and then again in the last 2 hours of market session. So if you're trading SPY or QQQ, you want to trade the directional trending moves when volume is the highest. In the middle of the day, volume decreases. The market begins to slow down, spreads widen, and most beginners force trades that aren't even there. And another tip is pay attention to catalysts. Earnings season in the United States is massive for options traders. For example, when Starbucks reports earnings, their premiums explode. Same with Amazon during holiday quarters. You don't need to gamble on earnings, but you just need to know when they are so you don't take on any extra unnecessary risk. So the smartest play is to build a watch list of 5 to 10 US companies that move and trend smoothly. Learn how they behave and trade them at the time of the day when the setups are the cleanest. You don't need 50 tickers, just a handful that you actually understand and build a relationship with. Because at the end of the day, to make $10,000 a month trading options, you don't need to chase every move or follow every signal that you receive. You just need to know what to trade and when to trade it. Because the goal isn't to make one lucky trade, it's to build a skill that pays you for life. If you found this helpful and you want to go deeper, I put together a full step-by-step video on how to start options trading as a beginner. You could click it right here on the screen. I'll walk you through the basics, a live example, and how to avoid the traps that most beginners fall into. I'll see you there.